You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today we've got Jon Turek, who is the founder of JST Advisors. He's also the writer and publisher of the Cheap Convexity blog that you can find on Substack. Jon, thank you so much for being on the podcast. It is awesome to have you. We're going to have some fun talking about central banks and where we're headed from here in terms of inflation, rates, etc.
Thanks so much for having me on. I look forward to getting into it with you.
Awesome. So Jon, could you tell the audience a little bit about yourself, how you got into finance? And so, usually, as we were talking off the record, people start on the equity side, doing bottom up and then transition into top down. But, you got your start by, doing economics and macroeconomics and you got your start into markets from a top down perspective. So could you just talk a bit about your background and, your journey on Wall Street so far?
Yeah, sure. So, for me, I think like you, maybe not even as young as you, but on the younger side, got the bug early, starting around senior year of high school, I would say. I started getting really interested into macroeconomics. At my high school, I did the Fed Challenge program, which is kind of this competition between, I think they also have it at the collegiate level, but is kind of like a presentation of the Fed, best group wins. So I really had like an interest in macroeconomics and especially policy, going back at least until like the end of high school. From there I did, I did my studies at international school in Israel. I worked at More Capital for 2 years, on a hedge fund in New York. And then in January of 21, I started my own research shop, JST Advisors, which under it also has the Cheap Convexity blog. And, the business is basically this, two-pronged approach. One is, kind of a blog, 30,000 foot views on my global macro views. And then the other is more of an institutional product focused on global macro trade ideas.
Awesome. Perfect. And so, when you were at More Capital, what was it like, working, I guess, for one of the big hedge funds? And also, did you get access to, say, Louis Bacon? And did you have any cool stories from them? I guess it's always important to ask.
Yeah. So on the stories, I'll probably pass on that, but no, I had an amazing experience there. I got really lucky to work for an incredible PM, who's actually since left, but still have a lot of close contacts there. And, I think like it was really a great place to kind of learn the tools of the trade. As it like, More is obviously an extremely storied and rich, in history, macro hedge fund and really discretionary global macro. So really got to, think about things like not only having a view on what respective central bank will do, but also what is the most asymmetric structuring of that view, et cetera. So it was really a way to kind of harness my ability to really understand what the respective central bank is saying, but also kind of come out with the best way of expressing that in a market sense. And I think like that was really, honed there. And it was like you got a little bit of the cool vibes every day. I mean, yeah, it's Louis Bacon shop. So if that doesn't motivate you, nothing will.
Yep. I agree. And so, moving on, I wanted to start by talking a bit about the Fed. And so, there's just been a lot of talk about the Fed's pivot to hawkishness from being extremely dovish. And so, what's sort of your outlook on Fed policy going forward over say the next 12 to 18 months? Where do we go from here? And so, how much of that shift has been driven by political pressures versus not actual inflation prints?
Yeah, I think it's obviously been an extremely interesting environment for monitoring Fed policy. Going back into March of last year, which is basically at this point 11 months ago, at the March 2021 FOMC meeting, the Fed said they would be on hold through 2024. And now looking at where we are today, we have almost 7 hikes priced for this year. And I think a lot of this transition is happened in speed, but has also happened in kind of global trajectory. And what I mean by that is we do have kind of these idiosyncratic variables that has moved the Fed faster than they would have probably have liked to be moving, right? So we do have in the US an extremely robust economy that is adding price pressures pretty much everywhere, which was amplified by supply side fragilities due to COVID. But it's not just a supply side story. We have aggregate demand that's running at levels that are much hotter than they were even in 2019, when at the time we thought we had a fully employed economy with an unemployment rate below 4. Looking back, retail sales at a 2-year stack are running over 20% of what they were at that time. So we do have some excess demand in the system. And then also, I think what the Fed is dealing with is that this problem of tight labor markets and hot price pressures is not a Fed exclusive issue anymore. Looking at where we are globally, we have the ECB has a 5% inflation rate and almost the lowest unemployment rate in its history. We heard from the RBNZ last night, they have the lowest unemployment rate in many, many years there as well. And also with a 3 handle, also with 5 handle inflation. So the point is a lot of these wins are kind of global. And I think when they are global, it adds to how much the respective central banks need to do to kind of deal with it. And I think that this is where we are kind of in the central banking landscape, where on the one hand, we have central banks that are dealing with above target inflation and very low levels of economic slack. And on the other hand, it's that this is kind of happening in a global setting, which is very not analogous to the 2010 cycle, in which the Fed was often acting alone. And when that happens, the dollar becomes kind of the fulcrum instrument, which tightens financial conditions for them and ends up letting them do less on the rate side. But what's happening now is, and I think why we've been in this, I wouldn't say relentless repricing of positive term premium in the front end of the US, but certainly a contributing factor is not only that growth and inflation is a lot different this cycle than it was last, but also the global participation element, which has not let the dollar kind of help the Fed in terms of tightening financial conditions.
Right. And so, how accurate are the analogies to say 2018? So, that's been thrown around and people are describing the current environment as similar to, I guess, mid to late 2018. So, are you seeing elements of that at all? Or do you think, that's sort of a miscomparison?
I think there are some analogies that are worthwhile in the 2018 analog. I think broadly speaking, though, the 2018 analog is wrong because what's seemingly the key characteristic of this cycle, especially for the Fed, but in central banks in general, is that there's a level of synchronization in terms of the tightening policy posture. And this is really not what we saw in 2018. In 2018, we had a Fed that was kind of on this path to neutral, kind of following the fiscal stimulus that we passed in 2017, the tax cuts. But this was happening at the same time that China was actually beginning to slow quite hard on the back of their credit stimulus in 2016-17. Europe was entering or beginning to enter a manufacturing recession, also coinciding with weak Chinese credit impulse. And central banks, in other places such as New Zealand, by the end of the year, were considering cutting, and actually did. So what we had in 2018 was we had a world where the Fed was kind of on this beeline to neutral, right? Those famous Powell words that were still a long way from neutral. And we had central banks in the rest of the world that were finding themselves looking for ways to be easier, right? By the end of 2018, we had central banks that were cutting. We had a slowing Chinese economy. And we also had, people like the ECB that were debating adding QE. So this was really a pure policy divergence trade, right? The reason the 2018 trade was not necessarily rates higher across the curve, and it was much more focused in a much stronger dollar, was that there wasn't this kind of global participation. And in fact, there was actually divergence between central banks. And that, I think, was what kind of broke the cycle faster than otherwise would have happened, right? I don't think that on a pure domestic macroeconomic level, 2.25 on Fed funds is what hits the kibosh in the US economy. I think it's the fact that it was dealing with all of these cross currents that 2.25 was not tolerable for given the global economic conditions. And I think in comparing the cycles, I almost think we're entering an inverse of that right now, where the trade weighted dollar basically brought down the level of real neutral interest rates in the US, where now, because there's this global participation in FX is not, at least, cross currency wise, we're not seeing these outsized moves in either direction. It's not like the euro is ripping or the dollar is ripping or the Canadian dollar is ripping or the Aussie dollar. It's all kind of still relatively confined. So when that FX channel is not activated, you almost get this term premium higher move. And that's why I think globally we're kind of having this across the curve move higher in bond yields. Of course, it's focused in the front end because they're going to be delivering hikes this year. But I think, comparing now to 2018 in terms of this hiking cycle, I think is wrong. And it actually may even be the opposite. Now, are there 2018 analogies to what's going on in the equity market? That's possible. But I think at least in terms of thinking about the scope of this hiking cycle, 2018 actually may serve as an opposite rather than a helpful analogy.
Got it. And to an extent, people have argued that, when what we're seeing is slowing. And so when you think about aggregate demand, one component of it is household consumption. And so, people like, for example, Warren Mosler has pointed out that when real personal consumption expenditures and real disposable income have flatlined in the US. And then on top of that, we don't seem to be infrastructure. The infrastructure bill seems to be just relatively dead. And so going forward, what people are arguing is that, one, you're not seeing this growth in aggregate demand anymore. And two, once you start increasing rates, that makes it harder for aggregate supply to expand. And aggregate supply in this context is referring to the supply chains that are already being blocked, and which is part of why we're seeing inflation right now. And so people tend to argue that seeing, say, 7 hikes being priced in this year, that is actually a policy mistake. So how far do you agree with those arguments that pricing of hikes in the I guess say December 2022, early 2023, how much would you agree with that and say that it's the market is pricing hikes too aggressively right now?
Yeah, I think it's very interesting. And on the surface, I don't agree with many of those arguments. And I think what's rooted in that is the level of fiscal policy excess is either required or is kind of set off its own cycle. So, expanding on this a bit more, one of my core themes going into 2022 is that I was not really scared of the fiscal cliff because I think that the economy had enough wherewithal, enough private sector balance sheet health to kind of deal with a successful handoff. So, looking into this year when, it is true that at least in rate of change terms, the level of fiscal support is going to be materially lower than it was last year. There is a huge amount of private sector buffer, given that household balance sheets are in good shape. Wage growth is extremely high and, has at least started at the bottom of the income range, right? So at least, looking at the bottom quartile of income where Amazon and Walmart have reset kind of the wage scale, there's certainly more ability, and given that lower income wage growth is high, to kind of withstand some of these drop-offs, especially in terms of transfer payments, et cetera. And in looking at the corporate side, we had margin growth pretty much at all-time highs. We have a ton of cash on balance sheets. We have extremely low default risk across the credit spectrum, ability to tap into markets. So I think there was this general backdrop of, the private sector can take over. The question now is, as we begin to entertain where the Fed is going to go, is how much the economy can take relative to hikes. And I think that's kind of what we're beginning to entertain now. But I think in general, the economy is going into this hiking cycle in an extremely different place than it was in the last cycle. I mean, think about where we were in the 2010s. We were coming off a financial crisis, not a pandemic, which led to a massive deleveraging on the household and corporate side, and didn't have any commensurate re-leveraging on the fiscal side, right? So we had this combination of austerity, and we also had households that were delevering, and corporate balance sheets that also were delevering, and were also, even if they weren't, there was no real incremental value in kind of capex because the outlook was pretty bleak, potential growth was low, et cetera. Coming into this hiking cycle, all those engines are sort of in reverse, right? Households, as savings rates come down, have a lot of access to credit. Their home prices, and on average, went up 18 to 20% last year. There's a lot of home equity. Credit is really strong. Wage growth is really strong. And looking on the corporate side, if we look at like survey data, capex intentions are pretty much at all-time highs. And the reason is the story of last year was there just wasn't enough stuff. Now there's some degree of, kind of how much of that is fiscal excess and how much of that is trend growth. There will be an element of that. But clearly, in a world where the unemployment rate is around 4 and wage growth is where it is, capacity is going to have to expand. And companies couldn't be in a better position to do that right now outside of supply chain fragility. Just looking at from like a balance sheet perspective, they have access to credit. Their balance sheets are relatively healthy. Default risk is low. Margins are high. Like the impetus to get infrastructure and capex into the system, I think, is there. And then, to your point, the question is how much can you do when, interest rates go up? And that's something we're especially seeing on the housing side now, right? Where, housing demand is extremely strong, shortages pretty much across the space. But, is that going to still be the case in a few months when 30-year fixed is 4.5? And I think those are questions the economy is going to have to answer. My hunch on all of them is that the economy is in a place that it can handle more than we think right now. And I think this is a general theme for me thinking about, Fed rate hikes this year, is that if they really want to have a material deceleration in inflation, they actually may have to do more than they think.
Okay. That's a lot of good stuff to think about. And, to that end, since the economy, as you mentioned, probably has more capacity to withstand, I guess, any tendency to slow down. Is QT something that people should be scared of, given the dynamics that you just laid out?
Yeah, I think QT is an interesting one because on the surface, and really even in the details, we know so little about it, right? We've had one experience seeing it, and it kind of Fed lost control of it towards the end, mostly on a technical factor, not necessarily on anything else, right? The idea that the Fed could come in and start doing QT and the curve would steepen as the maturities that were rolling off were mostly on the long end didn't happen in 2018, right? The 2018 story was that because QT was coinciding with Fed hiking rates, it was still a flattener in yield curve terms. Now, what QT did activate was some serious weakness and fragilities in funding markets, which led to things like repo blowing out, which ultimately led to the end of QT. And they actually they didn't call it QE, but it was synthetic QE via bill buying. And the Fed pretty quickly from September 19 started, September 18, started buying bills to arrest any weakness in funding markets. So, the interesting thing about QT is in theory, if QE is supposed to flatten the curve, also something we didn't really see in practice, right? What we've seen in practice so far from QE is that the curve steepens during bond buying and it flattens during QT. And now we haven't really seen active sales, but in terms of roll-offs, the last cycle we saw that the curve flattened. And I think the reason that is the one thing we know about QE, and this is the most efficacious factor of it. And I think the Fed is aware of this. The ECB, at least under the Draghi regime, was very aware of this, where people like Benoit Courier had papers on it. The best part of QE in a policy sense is that it's open-ended forward guidance. The one thing we know about QE is that the Fed or the respective central bank doing it, but the Fed in particular, cannot raise interest rates while it is adding to its balance sheet in net terms. So as doing QE, no hikes. And that's a material ease, especially at the lower bound. So if the Fed says, we're at zero, but we're buying bonds for the next 2 years, the market's not really allowed to price anything until 2 years. And that takes what would have been natural positive term premium, because we respect the lower bound, out of the market, which is an ease in financial conditions, which kind of sparks, the whole feedback loop. The question is, in QT, does that really work in reverse, right? Does QT convey any information about the hiking cycle? And I think, the answer is yes and no. I think, for now, I think at the beginning, QT conveyed, when we started talking about QT, which was really at the end of Powell's press conference in December, was the first kind of hint we got. It was the end of the presser question. But then the January minutes showed it was a clear theme of the meeting. And then, so that's really when it began in earnest. And I think that conveyed information that the Fed was moving more hawkish, and it was on the back of this already hawkish pivot in November, post Powell's renomination. So I think it did convey information that the Fed was becoming more worried about inflation, and it was going to use tools to address that. Now the question is, the Fed is probably this year going to some degree rely on QT as a mechanism of tightening policy. And this is something I'm not convinced of, at least in a roll-off sense. I think there's certainly a degree of tightening that would happen if the Fed were to actively sell MBS. And kind of in that, recomposition of the balance sheet mode, I think there would be certain financial pass-throughs that would act as a tightening. But I think there is also an element where the Fed thinks that they can do a certain amount of hikes and a certain amount of balance sheet, and that will kind of get inflation back on track, not to target because it's so far away, but start closing that gap. And this is something we've heard from a lot of Fed officials, whether it be Bullard, Harker, Esther George, is kind of this idea that they can use the balance sheet to flatten the rate path. I'm, to be honest, I'm a little skeptical about it. And I think the market will become more skeptical about it too. Because there is an element of, you're accelerating something that was going to happen anyway, right? Like if the Fed didn't do QT, the balance sheet would shrink as a percentage of GDP just from them stopping QE. And, as that kind of comes down, there is evidence of the stock effect in terms of how big the balance sheet is. That kind of is a, broader term premium effect. But in terms of thinking about the curve, if the Fed is saying that they're going to be hiking to deal with inflation, the curve is going to flatten whether they're selling or not. And if the Fed says that we've reached what we want to do on the hike side, now we're going to focus on the QT side, or we're going to have this kind of policy mix that, the Fed not really talks, but I think there's some implicit bias that the Fed has, is that they can get the shadow Fed funds rate higher, which is this idea in academic circles that, the there's kind of this holistic policy rate, which kind of encapsulates QE, which was especially relevant at the zero lower bound. So when the Fed was not going to go below zero, but was adding QE, effectively the shadow Fed funds rate was falling further negative without the nominal policy rate falling. And I think there's some element now where the Fed wants to kick that into reverse, where the shadow Fed funds rate rises much faster than the nominal Fed funds rate. And they're going to use balance sheet to assist them in that. The question that I am skeptical of is that enough? I just think that the pass through that's more understood is on the policy rate side. And I think that we could be setting up for a situation where the Fed and markets kind of get to this understanding that they're really not going to do more than hiking at every meeting, and then hoping that being hawkish on balance sheet does the rest of the work for them. And I'm not sure the market will agree.
Got it. And so in a way, theoretically speaking, so, going back to the point on QT, QT is supposed to theoretically tighten financial conditions, which would then in turn be negative for risk assets, at least in theory. But, do people give more credit to the Fed when it comes to controlling the long end of the yield curve than the Fed can actually do? So, do you think, people think that, generally speaking, do you think people believe that the Fed has more control over, say, the 10-year or 30-year yield than it actually does?
Yeah, so I think the Fed has not so much control over the back end of the curve. I think there is this element in the tips market that is different this time, where there is almost this risk premium effect because the Fed has been such an outsized player in that market, where we did see when QT became more real, as we had this bit of flash move in real yields because that market is going to have a compositional change over the last 2 years with the marginal buyer buying less or stop buying. So I think there is an element where back end reals, because of what the Fed did post COVID, there is sort of this Fed effect. But in terms of thinking about the back end of the curve, I think it's really about what is the longer run policy terminal or neutral rate. And, the market is going to kind of hover around what its best guess of that is. And I don't know that, QT is going to be a big help in terms of them kind of changing that, right? If the market is of the view that 2% is terminal or neutral, then the 10 year is going to hang around 2%. I think mechanically to think otherwise, it just really we haven't seen it, right? I think there is this idea on the board, and not necessarily from the core. I don't think this is something we're going to see in a Powell or Brainerd speech, but it's something we've seen in Bullard speeches and Esther George speeches, is this idea that, we can steepen the curve to give us more room to hike. And, I'm not sure that's true. And it certainly wasn't the analog of 2018.
Okay, let's go across the pond to our friends in Europe. And, you recently published an article on the Cheap Convexity blog where you said, the ECB is resetting global term premium. So could you just discuss that theme a little bit? And, when Lagarde is sort of pivoting to the hawkish side from the dovish side, what exactly is changing there? And, what exactly does higher rates do in Europe, considering that a lot of European inflation is driven by energy and higher food prices, both of which are imported. So does higher rates actually make a significant difference when it comes to higher energy, higher gas, and higher food prices?
Yeah, so it's a great question. I think to me this is kind of the biggest theme in macro this year, and I probably get a lot of pushback on that because it's not Fed or U.S. inflation related. But I really think the idea or the possibility of the ECB getting off zero this year, I think is just such a fundamental game changer. Looking back to last cycle, as I probably noted in that post, if you kind of just chart, ECB policy rates versus global term premium, you kind of get the whole game, right? The ECB going negative and then going further negative was just this massive pull lower on global fixed income yields. And it was almost became an anchor. And the Fed certainly felt this in 2018 when they seemingly couldn't get much above 2% in Fed funds. even though they had an economy at full employment and close to target inflation or at target inflation, is that the ECB was just this anchor on global R star, and I think that's the best way of putting it. And that could be changing, and probably more than could, almost likely will be changing. And I think about thinking about at least the micro ECB factors before we get into the macros. Thinking where they are. They have, tried to push off this inflation story as one of, as you said, is mostly energy and food, right? The ECB has been very clear in saying that, 50% almost of the excess gains in inflation come from energy. And that's true. The problem the ECB has, and this is a problem that I think becomes more, relevant to every central bank, is twofold. One, if you have a terms of trade issue, being dovish weakens your currency, and weakening your currency only amplifies those issues. So as you said, the ECB, Europe is a big importer of food and energy. Having the euro go down is not really the sort of thing you would want in that backdrop. The second problem is, and this is something where the Fed found themselves, this is something where the Bank of England outwardly found themselves, is you can play the transitory card, right? And, for the first 3 months, for the first 6 months, even the first 9 months, you can say, these are the reasons that inflation is higher. We expect them to come back, and we don't feel like we need to act on policy preemptively. The problem is when that inflation doesn't come down, even if it's still on the factors that you associated with them as transitory factors, right? The ECB has not had this huge shift where they're like, look at all this inflation that's coming from all these excesses in the euro economy. It's not what they're saying. They have noted that slack in the economy is much lower than it was, especially last cycle, that housing prices are much higher, etc. They have noted there are demand side components, but it's not this, the economy's overheating, we have to move, right? But what happens is when inflation runs so above target, for now it's going on, at least a year. But a year since really the big inflation prints started coming in. I think it was March or April where we got our first 0.9 month-over-month CPI print in the US. Is that there becomes a risk that central banks begin to worry about inflation expectations. And there is no gradualism, there's no transitory, there's no let's wait and see, right? On the spot inflation could be above target, and central banks could say, okay, let's see. But on terms of inflation expectations, they're always going to be preemptive. And I think this is kind of the inflection point that we've entered, really Q4 of last year, Q1 of this year, which is to say that, yes, it may be that in the UK, that inflation is extremely hot for X, Y, and Z reasons. Same thing in Europe. A lot of it is imported, a lot of it is supply side, a lot of it is commodities. And these are in theory things that the central banks don't target. They target demand. They don't target the supply side. But the problem is that when inflation and spot inflation is high for so long, the risk of inflation expectations moving higher becomes more entrenched. And that's where central banks are preemptive. And that's where I think, a lot of people missed, kind of the impetus for the ECB pivot. It wasn't only that, oh, look, the Fed could be hiking all these times, or that inflation's at 5%, but a lot of that's energy. It's that, one, of course, there are some political variables that make it tough to hold the line that inflation's not a problem when every politician is telling you it is. But secondly, there becomes the risk that, especially at low levels of economic slack, that you could have a move in inflation expectations. And those are not something where you play the transitory card. That's where you play the preemptive card. And that's where I think the ECB is finding themselves. So they basically now are probably going to hike back to zero by the end of the year. At least that's what markets are suggesting. The last time I checked, ERZ2 is around 99.95, a little bit above zero on the policy rate. And I think, kind of looking back to last cycle, again, a lot of these themes are really almost inverse of last cycle, where the ECB was this massive pull lower on global term premium. And I think that that's being reset. And now what's interesting about it being reset is, at least in the leaving negative interest rate policy world that we've seen, we saw it from the Riksbank in 2018 in Sweden, and they never went negative again. And we had a pretty material crisis in 2020, which was a catalyst for everyone who could cut rates to cut rates, and they didn't cut negative. And I think what could be very interesting about the ECB is, as they get back to zero, does the market not only has to price them getting back to zero, which has obviously led to some of these massive moves in fixed income this year, but also the idea that they're not going to go negative again. And that's really the Riksbank model. And if that's the case, then European fixed income kind of has to be repriced, not only cyclically, but structurally, because the distribution now is changing, where it's back to a zero lower bound world and not what they would call an effective lower bound world. And I think that domino in terms of, term premium going higher across the world, I think is pretty material force. And I think it could be thematically important for the rest of the year, at least.
Yeah, no, I think that was fantastic. And, moving on, when it comes to, say, China or Japan, so, what do you see forward when it comes to, the Far East, I guess, and when it comes to places like China, a lot of people have talked about Chinese property market slowed down. Evergrande was a big thing that everyone was looking at. And two, other than this, so people argue that when you look at the Chinese credit data, the data that came in for Feb was highly influenced by the Chinese New Year celebration, and then beyond, which ends up being a seasonality, and then beyond that, what we're going to see is Chinese credit start to slow down as well. And so. And you also recently published an article about the Chinese yuan and whether the world needs a stronger or weaker yuan. And so could you just give your thoughts about China, Japan, and I guess what you could call the Far East?
Yeah, I think China's in this very interesting place now where, last year and really kind of since they ended most of their policy accommodation, China's been extremely reliant on external demand, kind of replacing the lack of aggregate demand they've had at home from a credit channel that got crushed, mostly on these property sector reforms, but also on monetary policy tightening post-COVID. So China's approach last year was, let's deal with these things at home and hope that the rest of the world, with their really strong levels of nominal demand, will import that. And we saw Chinese current account blowouts to huge levels. Chinese trade surplus was huge. China's current account went from, basically flat in 2019 to over 3% in 2021. And I think a lot of it is that China wanted to tighten on the policy side, and they also wanted to implement a lot of this reform agenda that was especially painful for property, tech, et cetera. And the idea was we can import a lot of demand, given where US and Europe, and really the Western world levels of demand is right now. And that was seemingly effective, right? Chinese growth slowed, but it didn't fall off a cliff. And now the question going into this year, as those high levels of Western growth begin to moderate, fiscal stimulus is no longer a factor, monetary tightening is coming. China has a domestic growth issue. And, seemingly the response so far has been, we're at the early stages of a mini easing cycle. Now, this is not going to be anything like 2016, 2011, or 2009. This is not going to be some sort of flooding. They've been explicit about that. But what have we really seen since December of last year? We've seen a lot of moves. One, we've seen them cut their policy rate. We've seen them cut their loan prime rate, which is kind of their bank target rate, which is becoming de facto policy rate. They've cut their MLF rate. They've cut their open market operation rate. They've added liquidity to the system. We've seen signs from state council that they're interested in further easing. They've pulled forward credit quotas for local governments. They've even backed the currency. They've even backed off the currency a little bit, where we've seen either in the fix or in the Forex reserve ratios them push back against excess yuan strength. So there's clearly this move afoot to on the margin ease conditions in China. I think this is something that'll probably become more amplified post the Olympics as kind of the industrial side of the economy picks back up again. But, I do think we're entering this 1 to 3 quarter period where growth in China is going to be better, because policymakers have basically put in the floor. This is not to say they're creating right-tail conditions for a massive boom in Chinese growth. I don't think they're really interested in that. But China, at least on the policy side, is telling you they want growth higher than it was in Q3, Q4, in Q1, Q2. And if they want it, they usually get it. So, I think that China's in this interesting phase where they're doing this at the same time that the rest of the world is tightening. So, the theme for me is kind of this central bank synchronization where really all the central banks are moving one way. China is not. And, I think this could be an interesting theme to play out, as this is really an episode of policy divergence. I don't know that it's like, dollar China much higher necessarily, but I could envision a world where there are FX pairs where, cross China does better, especially as the RMB was kind of in the dominant currency for the last 2 years. There's been no better trend in FX than a stronger Yuan. And China seems to be saying now is that they're willing to sacrifice a little bit of that strength to add some domestic support in the face of, material headwinds, kind of, even if they're from their own doing. So I think that is extremely interesting. The other part that I think that it's interesting is that we're having China add to levels of global economic output in a time when economic output's really strong. And I think this is another factor in terms of thinking, where central banks can go, and maybe they can go farther than they did last cycle. And I think likely will go farther than they did last cycle. And I think, an example of this is what we saw last night from the Reserve Bank in New Zealand, where, they've been probably at the forefront of kind of this hawkish pivot. Right over the summer, they ended QE abruptly. They hiked rates, not at the August meeting, but the next one, they've hiked rates now at 3 consecutive meetings. And then last night, they come out and tell you that they no longer think that neutral or terminal is 250. They now think it's 325. And I think the interesting thing is we're dealing with this cycle of central banks trying to get back on side with unemployment that's at really low levels, inflation that's at really high levels, corporate balance sheets that are pretty strong around the world, granted more strong in the US than elsewhere. And now we're going to get a bit of a push from Chinese growth. Like, I think, on balance, all of these things are kind of saying the same thing, that these guys are going to end up going more than they thought. And I think, if the Reserve Bank in New Zealand is kind of any indication, and I think they are, this is kind of the next stage of the cycle. And so, I think China has that twin component that is really interesting right now, where they are clearly an outlier in the global cycle. And also they're going to be adding demand at a time when other central banks are effectively trying to moderate it.
And with this framework, I guess, across the world, what sort of opportunities do you see, especially in FX markets? So considering one, you're seeing that central banks are hiking in a synchronized fashion. So, how are you thinking through opportunities in FX, and then, opportunities on, general global macro front?
Yeah. So, I think in FX, there are, 2 themes. I won't do specific trade recommendations, but I'll kind of give the framework. I think the theme in this, I guess, kind of is one, is that the ECB is leaving negative interest rates, and I think that is a humongous shift that I think in whichever cross should benefit Europe. The second theme is that because this is a global cycle, the effects of kind of outsized moves in the very front end of yield curves and their pass through onto currency will be relatively muted, which will mean that the outlet for a lot of these moves in central bank policy will stay in interest rates. However, I do think they're beginning to see some interesting trade opportunities where in FX, where the trade is not when the central bank can go, but where the central bank can go. And, an example of one of these things to me is, thinking about a currency like sterling, where on the surface, they've hiked at 2 consecutive meetings. They're going to continue to hike. They have said outwardly that they want to moderate demand. Their forecasts are for unemployment to rise. They are, in theory, a hawkish central bank. But the question is how far can they go, right, in terms of the level of interest, i.e., what is their neutral rate? And thinking about other central banks like the RBNZ, who have come out and said that their neutral may be as high as 3.25, or at least that's their terminal rate. So I think now the interesting trade is not thinking about currencies in terms of who is the next mover, but rather where are they going? I.e., it's not about who's next to hike, it's about who can hike the most. And I think that will become a more interesting FX theme, kind of in this world where pass-throughs are relatively muted because it's happening in a world where everyone's doing it, right? The reason that sterling doesn't jump on hawkish BOE days is because when the BOE is hawkish, then Euribor futures also sell off, and when the ECB is hawkish, SONIA futures also sell off, right? We're in this synchronized tightening world where more tightening from a key central bank leads to more tightening from another key central bank, and we're kind of in this hawkish domino that it's not obvious kind of what the FX pass-through should be, at least in the front end of the yield curve. But in terms of thinking about the destination where these guys can go, I think that's where the next FX theme is probably developing.
Got it. And then I guess from a general, non-FX, general macro front, what all are you watching in terms of teams?
I think there too. I think there's the theme of, again, the ECB leaving negative interest rates, which is to me a game changer in terms of where, not only where central banks can go in terms of hiking, but also just global term premium in general. And then the other is, I think the big question now going into the end of the year is how much is the Fed really willing to do? And by that I mean is the Fed here to tell us that inflation is dead and they're going to kill it? Or is the Fed going to say that there's a level of inflation that is, even though it's materially above target, they're not willing to make quote unquote hard sacrifices to get it back to target? And I think the example of this will be, kind of thinking about Q3, Q4 of this year, when inflation will begin to decelerate. The question is at what rate? And where you could have a situation where inflation ends the year 3.5, 3.75 on core PCE, which will be 100 basis points above the December forecast, probably 50 basis points above the March forecast, which we'll see in a couple of weeks. And in theory, that's the Fed taking the L on inflation. It should be another incremental factor to them to be more hawkish. But the question is, does the Fed say, we're not willing to tolerate a 2% rise in unemployment to get inflation back to a 2 handle? And that is, I think, really the question now in thinking about the long end, right? Because the long end US is, in theory, if the Fed is going to come out and say they have an inflation problem, they're going to get it back to target. They're going to have to slow growth a lot to do that. And if they were to do that, then the long end should start falling in yield, and the curve should actually go inverted across most maturities. But if the market is starting to get the sense that the Fed is willing to tighten, but do the easy tightening, not the hard tightening, not the tightening that has a real palpable output labor market cost, then the long end doesn't have to rally. In fact, it'll probably sell off as that risk premium has to be added. And is that the reason things like gold, X these geopolitical factors, are starting to rally? We've seen emerging market currencies do really well this year. Is the market beginning to sniff out the Fed is going to be hiking this year, but it's not going to be in a hiking regime of really killing inflation, more slowing inflation.
Right. Mm-hmm. Yeah, no, that's and when it comes to your first team, when you think about Europe increasing rates. Now, do you think that when they have higher rates, higher energy, and higher food prices, and then on top of that, when you have some sort of a geopolitical conflict right next door, do you think as a whole, that combination would be more bearish for the euro rather than bullish? Again, goes back to the theme of the central of the ECB discussing that about, as you mentioned, half of inflation was caused by energy price increases, which is imported from mostly Russia. And so, when you've got this geopolitical kicker of Russia, Ukraine, do you think that that's good? Do you think that actually hiking rates is going to make the whole situation worse, which would be bearish euro, or do you think that's a fundamental shift which would make you bullish euro?
Yeah, I mean, I think it's more the latter, right? Because I think what we've had is kind of a 6 to 7 year period where from 2014, where the ECB began its negative interest rate policy, until 2019, where they cut further negative, is we really had this relentless flattening of the yield curve in Europe, which in easing cycles shouldn't happen, right? In easing cycles, the curve should steepen. But thinking through like how much of it is mechanical is for reserve managers and real money across the world, like having access to a bigger universe of European fixed income that has positive yielding debt, I think is just a much more fundamental tailwind to the currency than, say, kind of these terms of trade issues. And I think, on balance, is that a higher currency does begin to alleviate some of the pressure on these terms of trade factors. So, I think that, mostly is, it's a capital flow story, where real money is just going to get access to a new universe of positive yielding debt in, the second biggest government bond market in the world. I think that is a huge story. And, in terms of thinking about the hiking cycle effect on the European economy, especially in the context of the trade issues it's having on the import side, I think there is an element where the ECB is actually looking for a stronger currency to alleviate some of these pressures. Now, that won't be the explicit policy, but implicitly, I think there's some desire to let or have the currency help.
Yeah, I see. And to wrap up the podcast, what are your favorite resources to learn about one central banks, and to just understanding central policy dynamics and how they play out on a global macro scale?
Favorite resources,
because books, papers, etc. that
yeah. So I in terms of like, I guess I am a little bit of a central bank nerd. I really do like, old papers from policymaker. Yeah, a little bit. I really do value like old papers from what I think to be are like marginal policymakers. So, earlier I mentioned Benoit Courier, thinking about, reading like Ben Bernanke, and, really policymakers at their respective central banks that kind of set the academic tone. I think like those papers are pretty invaluable. And then, I think like in terms of, following the central banks, I think that something that is really helpful for me is for obviously reading the speeches, reading the statements, watching the press conferences, but always comparing it to the last. So really what I like to do is if, Brainerd has a speech in the US, I want to read the speech, and I also want to reread her most previous speech as kind of a way to like, where are the shifts? What has changed? What is she focusing on that she wasn't? What is she now not focusing on that she was? And I think like that is a very generalized theme for me in terms of central bank watching, where, like on an ECB day, or their statements don't change that much, but thinking about the Fed or someone like that is I sit with, the current statement and the old statement. And I think like there's a lot of value in this is how they communicate, right? Like a change in a word is how they communicate to markets. And I think being really in tune with that is I think a big value add as a central bank watcher. And I think that the finding also the added element is figuring out who the tone setter on the board at that time is. That's something that I spend a lot of time thinking about. Right. Like, and it changes. It's fluid, right? Where, like, 2 years ago, I would have said that Philip Lane is the tone setter on the ECB. And now I think it's more Schnabel. But on each central bank, kind of finding the non-governor who's really laying down or setting the tone for policy of the respective central bank, I think kind of lets you get a bit ahead of the curve.
Well, Jon, thank you so much for being on the podcast. This was awesome.
Thank you so much. And I just want to say that, I listen, and it's amazing what you've built at such a young age. I mean, I always felt like I was the young one in this business, and you're much younger than me.
Thank you. I appreciate that. Thank you so much.
It's awesome. It's awesome.